What's happening, traders, and welcome back to Shifty FX. What you see here in front of you is a comprehensive breakdown of your daily bias using a two-candle theory and understanding where your internal to external range liquidity is. What we utilize here is just a simple approach, understanding what the previous day's close does is going to dictate what we look at in the morning. Okay, has market tapped into a PD array? Has it given a strong close to the downside or upside, depending on which array it may be? Yes. Can I target that high or low of the previous day as my lowest hanging fruit? Yes. There are scenarios here that I have highlighted to the downside, which we will get into later on, giving examples of where we don't trade, which is quite simple because at close of business, we could have a look at the charts, go, well, that formation's taken shape. I'm just not going to get into the trade the next day. Okay, but a lot of the time, 95% of the time, I would say, you will have an edge in your favor using these formations at the upside. This doesn't mean we're going to trade every single day. If you're looking at about 5 trades a month, taking about 3 to 5 R each trade, you are making unbelievable amounts of profit. And we just need to keep it that simple. Okay, so what we see here, we'll break down the formation and then we'll get into an example straight away. So we have a rejection 2 candle theory, which is a candle 2 is the smart money reversal manipulation, and we can anticipate that candle 3 is going to expand. Yeah, market taps in, sweeping external range liquidity, tapping into that weekly fair value gap and giving a good rejection. At this point, we can anticipate candle 3 is going to expand further, taking out that previous day's low. Second example is a swing formation after candle 3 closes, anticipating that candle 4 is going to expand. Over here, market rides up, not taking the external range liquidity within this daily fair value gap. Candle taps in, gives a strong rejection. Candle 3 closes to the downside. We still have our external range liquidity available. We can anticipate that candle 4 is going to continue in that fashion. Example number 3 is a continuation candle. What this is just highlighted over here. Once market has rejected, we get that strong close below the previous candle's low. We can assume that the continuation is to the downside. Number 4 is a draw on liquidity continuation candle. Now, there's a lot of instances where guys will tell you if a previous day's candle high or low is taken, you can anticipate a reversal at that point. That's not the case, guys. It depends on what the market has done, essentially. Okay, so if you get an instance and a candle does this, and then the next candle opens, pushes up, pushes down, and then closes within there, you'll see a lot of guys talking, oh, it's closed within that previous day's low, you can look to target the upside. Absolutely not. This is where internal to external range liquidity is so important. Okay, so this example, if we look to the upside over here, you'll see in this instance, candle has rejected. Good indication that we can target this low. What do? We target that low, but we close above it. Now again, this doesn't mean that we are now going to look to target that previous day's high. Absolutely not. We are using a drawn liquidity continuation. What is our drawn liquidity? Well, we've tapped into internal/external range liquidity in this instance by sweeping the swing high, tapping into a weekly. Our next draw is to the downside. We can use this momentum to ride our way down, targeting this external range liquidity. Okay. Sweep continuation formation, the last example. This is where market could be over here, for instance. You can use this as a reversal formation, sweeping a previous day's high, or sometimes what you'll find is this forms within the continuation once a fair value gap has been formed over here. You'll see in these examples, we don't really have it. If a fair value gap is formed, tend to have a candle close and a sweep of that, tapping, still riding that internal range liquidity. Good couple of examples where we do not trade are sweeper candles. Okay, this depends on you. Okay, my understanding and the way we look at the charts is once you have a sweeper candle in the middle of nowhere that doesn't make sense, we tend to stay out the market. You'll see here, doesn't really make sense at the moment. Yes, it's mitigated there. Yes, it's taken that low, but we've closed as like a doji candle. So I'm just going to sit out for now. Okay, I'll wait for that candle to close. Candle closes up. We know the draw on liquidity is to that weekly fair value gap. We can look to capitalize on next candle, riding that momentum up. Where we can use a sweeper candle is once this has mitigated something. Because what you'll find is you'll see market could open, take that low, like it does in this instance, pushes all the way up, and then closes back down. It should have given on this side, but you know what I'm trying to say. In this instance, you'll see here, there's a sweeper candle. So market has opened, it's pushed up, taken external range liquidity, tapping into this fair value gap and closing to the downside. At this point, it's giving you a good indication that we've swept liquidity, closed to the downside. We've even closed within this candle's low. Where again, guys are teaching that you can now target that high. Absolutely not. Absolutely not. We have gone from external / internal, now looking for the next draw on liquidity. Okay, you'll see there, market closes down. We can now target down and down. That simple. Next example, inside bars. We do not trade inside bars. What we have on our charts is the inside bar indicator, which should appear once it loads, that we tend to use those as range liquidity. We'll wait for market to sweep, show its hand, there it sweeps, closes to the upside, and then we can try and progress from that point thereafter. Inside bars are just, in my opinion, not a high probability situation for a continuation. Okay. Excuse me, guys. Thirdly, array candles. Here's a good example of an array candle. We see market closing to the upside, aggressively closing within that fair value gap. At this point, we're not getting a good indication that market has rejected or respecting that daily fair value gap. What happens next? We get an inside bar. Inside bar then gets swept, giving us a close to the upside. At this point, we could then try and ride that swing high. And we can go 1, 2, 3. Multiple days to try and capitalize on that trade, understanding that we are most likely going to target that high again, get our rejection candle and ride it down. And then a fair value gap rejection inside candle is literally this. Once market has created momentum to the downside, giving you a good indication that a fair value gap has been created, the favors are against you when we see a strong rejection or we see an inside bar form. As at that point, we need to assume that market is going to target this fair value gap over there. In this instance, we close above it, targeting this order block over here. Market respecting it, giving an inside bar. You've seen in my previous video on GBP USD, we did not look at EU because it had an inside bar. GBP USD managed to sweep that high, close below, giving us an understanding that we could possibly target this low. We then got a candle rejection, closing below this one, and I managed to capitalize on a trade yesterday, reaping about 1.5%. Closed out early because the momentum wasn't in my favor and it was late in the day. That's most likely due to NFP, but just using the same boring, monotonous approach day in and day out, guys. Okay, so I recommend taking a screenshot of this, back testing it, seeing examples that you can find, and then inside of those scenarios, try and figure out how you can capitalize on a trade. Using this rejection candle here, for instance, go into the lower time frame, whether it be the 1 hour or the 15 minute, see where swing level is, see where fair value gap is, and how you can get in. There is absolutely no shame in taking a trade like this if you want to. It's 2.9%. I think people are so fixated on the lower time frames at this point that you tend to forget that bias and narrative have immense control over the markets, and you trying to execute on a 1 minute or a 2 minute and getting stopped out and missing the move is jeopardizing a lot of what you do when it comes to the markets. Your psychology, your confidence, everything. So just have a look how you can figure out to get into these moves, even if you execute on the daily. All right, traders, I hope that helped you in some sense. And if there's any comments, please just post them and I'll get back to each and every single one of them. All right, have a good one.